Welcome to the deep dive. Today we're looking at something more than just, a tech update for finance. We're diving into a topic with truly massive geopolitical implications, the future of money itself. Think of it like a quiet revolution, almost a financial remapping happening right under our noses.
Exactly. It's way beyond just how we tap our phones to pay. This is fundamental. It's about how value is exchanged, how it's managed, who controls it. And that has huge weight for national power, global influence, even, individual liberty. The stakes are incredibly high.
Right. So our mission today is pretty ambitious but clear. We want to really dissect and understand the digital currency strategies of the US and China. These two giants are taking very different paths. Why? And what does it actually mean for all of us?
And to get our heads around that, we've looked at some really solid sources. We've got white papers from big players like State Street, JP Morgan, analyses from Forbes, Investopedia, and crucially, reports from the Bank for International Settlements, the BIS. They're like the central bank for central banks.
The BIS, yeah. That gives us that crucial high-level view on policy thinking, doesn't it? Okay, let's try and untangle this web of finance, tech, and power.
So before we jump into the US versus China angle, let's just quickly make sure we're on the same page about digital currency. It's not just online banking. It exists only electronically. No physical coins or notes. Transactions use computers, digital wallets, the internet. But here's the really key thing. It's not just about making cash digital. It's redefining what money is. And maybe more importantly, who controls it.
That control point seems central. Okay, so within digital currencies, we've got these two main types emerging, CBDCs and stablecoins. Let's start with CBDCs, central bank digital currencies. What's the core idea there?
Right, CBDCs. Simply put, they're digital currencies issued directly by a country's central bank, regulated, state-backed. China's digital yuan, the ECNY, is the big example everyone points to. And the crucial part is they run on a centralized ledger. The central bank manages it directly. That gives them, direct control and full oversight.
Full oversight. That sounds like it has major privacy implications.
It absolutely does. Privacy is, let's say, limited in a system like that. The central bank, like the People's Bank of China with the ECNY, can potentially see every single transaction. Now, the justification is often fighting financial crime, giving them this unprecedented transparency, real-time economic data, spending habits, capital flows, you name it.
But it also raises that fear of programmable money, doesn't it?
Exactly. That's the unsettling part for many. The idea that the state could, say, put an expiry date on your money or restrict what you can buy with it. Imagine your digital cash only works for certain groceries or disappears after a month. That's a profound shift.
Wow. Okay, so given those implications, why are nearly 100 central banks looking into this? What's the upside for them?
Well, a big one is financial inclusion, reaching the unbanked or underbanked. Think of places where mobile phones leapfrog landlines. A CBDC could offer direct digital finance access. Then there's efficiency, potentially lower transaction costs, less hassle than physical cash, and stability. A secure, state-backed digital option compared to, volatile private cryptos.
For policy.
Oh, it's a powerful tool. Direct monetary and fiscal policy implementation. Think direct stimulus payments straight to digital wallets, or even potentially applying negative interest rates if physical cash becomes less common. It gives them much more direct levers.
That momentum, nearly 100 central banks exploring. It's significant. And you mentioned private cryptos. Has their rise sort of pushed central banks to act faster?
I think absolutely, especially for more developed economies. Maintaining financial stability, monetary sovereignty, that's become a key driver. They see CBDCs partly as a response, a way to keep control in a world where digital money is exploding, often outside their direct influence.
Okay, so that's the state-driven CBDC side. What about the other side? Stablecoins. How do they fit in? They seem to be driven more by the private sector.
Right. Stablecoins are designed to hold a steady value, usually pegged one-to-one to a fiat currency, most often the US dollar. The whole idea is stability, combining the reliability of, say, the dollar with the tech efficiency of crypto networks. Makes them much better for actual transactions or holding value within the crypto world compared to something like Bitcoin.
And some big players have emerged here, right? Building this almost parallel system.
Totally. You have things like USDC from Circle, Tether's USDT. They've become fundamental to the crypto economy. They stick to that one-to-one dollar peg. And what they've done is effectively create a private digital dollar system. It runs largely outside traditional banking rails, allowing for super fast, cheap, often borderless transfers of dollar value. Until you cash out, you might not touch a traditional bank.
And there's a financial inclusion argument here too, similar to CBDCs.
There is. Proponents argue stablecoins can reach the unbanked globally. Anyone with a smartphone and internet could potentially hold dollar value, send money, even tap into DeFi decentralized finance. Things like lending, borrowing, all on blockchain networks without the usual banks.
But there are risks, big risks.
Oh, absolutely. It's crucial to remember the hazards. Stablecoins usually don't have things like FDIC insurance like your bank deposits do. And even though they use decentralized tech, the issuer can become a central point of failure, a centralized risk hub. We saw that with USDC, right? When Silicon Valley Bank had issues, USDC temporarily lost its peg because some of its reserves were stuck there. Peg risk is real.
So boiling it down, the key difference between CBDCs and stablecoins is?
It really comes down to control, issuance, and sovereignty. CBDCs, like the ECNY, are about central bank control, enhancing state monetary power. Stablecoins are private creations, designed to basically extend the reach of existing fiat currencies, like the dollar, using private innovation.
Okay, that distinction is clear. Now let's get into the geopolitics. Given all this CBDC momentum globally, why has the U.S. been so cautious compared to China, which is really pushing ahead?
Yeah, the U.S. has been notably tentative. The Fed's done research, sure, but Chairman Powell has been very clear. A U.S. digital dollar would need Congress to explicitly say yes. It's not something the Fed feels it can or should just do on its own. It's seen as a massive policy shift.
And a big part of that hesitation is privacy, isn't it? That seems to be a huge sticking point in the U.S. debate.
A massive sticking point. The idea of the government having a direct line into everyone's transactions, that raises major red flags for many Americans. Fears about surveillance, direct digital taxation, that programmable money we talked about where the state could control your spending. You've even got politicians basically vowing to block any attempt at a digital dollar.
So huge political hurdles. Anything else slowing the U.S. down?
Well, unlike some countries maybe looking to leapfrog older payment systems, the U.S. already has pretty efficient domestic payments. They just launched FedNow, for example, which speeds up bank transfers significantly, often clearing in seconds domestically. So there isn't maybe the same urgent need felt for a CBDC purely for domestic efficiency gains compared to countries with clunkier systems. Combine that with the political and privacy battles, it explains the caution.
Okay, so if a U.S. CBDC is on the back burner, what is the U.S. strategy then? How does it plan to keep the dollar dominant in this digital age?
Well, instead of going the direct CBDC route, the U.S. seems to be implicitly and sometimes explicitly supporting the private dollar-backed stablecoins. You saw hints of this in policy discussions, sort of encouraging their use globally. It's almost like they're outsourcing the digital dollar's expansion to companies like Circle and others. Let private innovation run with it under the dollar umbrella.
And that helps maintain the dollar's global role, since, over 80% of trade is still invoiced in dollars?
Exactly. Private dollar stablecoins basically carry the dollar's dominance into the digital realm. They make it easy to transact in dollar value on crypto networks, in DeFi, keeping the dollar relevant without the government needing to build the tech itself. It's a clever sort of hands-off approach.
And there's that other really interesting angle about U.S. treasuries.
Ah, yes. That's a fascinating, maybe underappreciated strategic element. Stablecoin issuers have to back their coins with assets, mostly safe, liquid dollar assets like U.S. treasuries. So the more popular dollar stablecoins become globally, the more demand there is for U.S. treasuries to hold as reserves. And remember, something like 98% of stablecoins are pegged to the U.S. dollar. So global crypto users are indirectly helping to fund U.S. debt. It's quite something.
It really is. But letting the private sector lead, it's not all smooth sailing, as you mentioned, with the risks.
Definitely not. Those risks are real. The potential for instability, the lack of consumer protection. Regulators are stepping in globally. Look at Europe's MiCA rules demanding transparency, proper reserves, audits, trying to make stablecoins safer.
But there's a twist, right? While these dollar stablecoins project U.S. influence, they can also be used against U.S. interests.
Precisely. That's the paradox. Adversaries, like Russia reportedly, can use things like Tether, a dollar stablecoin, to get around traditional sanctions. Buying things they need, bypassing the controlled financial system, it kind of blunts the West's sanctions power. So now you have calls to regulate stablecoins more tightly for national security reasons. It's complex.
Which brings us neatly to China. Their approach couldn't be more different. Aggressive CBDC adoption.
Totally different playbook. China is, without doubt, way ahead on CBDC experimentation. The ECNY pilots are massive. Across major cities, hundreds of millions of people involved. They're testing it for everything, from everyday shopping to bigger business transactions, gathering tons of real-world data.
And their system uses a two-tier model, right? It doesn't cut out the commercial banks.
Correct. The PBOC, the central bank, issues the ECNY to commercial banks. Then the commercial banks distribute it to us, the users. This avoids completely disrupting the existing banking system, what they call disintermediation. It leverages the bank's infrastructure and customer relationships. Smart rollout strategy.
But that underlying control, the transparency for the state, it's still there.
Oh, absolutely. That centralized ledger means the PBOC potentially gets this incredibly detailed, real-time view of the economy. Spending patterns, money velocity, regional differences, unparalleled insight. Plus, that option to program the currency, add specific rules or restrictions. It's a powerful state tool.
And a big driver for China is escaping dollar dependence,
Yeah.
right? Especially seeing how SWIFT can be used for sanctions.
That's a huge motivator. Monetary sovereignty. SWIFT works, but it's slow, can be costly, and crucially, it's seen as influenced by the U.S. China saw Iran, Russia cut off. They want an alternative, a system they control that isn't vulnerable to U.S. sanctions. The digital yuan offers a potential pathway for countries to trade directly, bypassing the dollar system if they choose.
And the sales pitch is efficiency, speed and cost savings versus SWIFT.
Massive efficiency gains. SWIFT can take days. The digital RMB cross-border system, they're talking settlement in 7 seconds. And slashing handling fees by like 98%. For international trade, that is a seriously compelling advantage.
7 seconds. Are we actually seeing this translate into reduced dollar use? Is de-dollarization happening?
We're seeing clear signs, yes. It's accelerating. Look at ASEAN RMB settlement volume there, shot up 120% between 2021 and 2024, over 5.8 trillion yuan. 6 ASEAN nations now hold RMB in their reserves. Thailand did an oil trade in digital yuan oil. That's traditionally pure dollar territory. Reports say over 87% of countries are now digitally linked to the RMB settlement system, with total volume over $1.2 trillion. It's gaining traction.
And it's tied into their bigger Belt and Road strategy, the digital Silk Road.
Exactly. The ECNY isn't just about payments. It's a core part of the digital Silk Road vision. They're integrating it with other tech systems, their Beidou satellite system, quantum communication, to create this seamless trade infrastructure. The goal? A potential 400% efficiency boost for Belt and Road partners trading with China using the digital yuan. We're already seeing examples. European car makers paying Arctic shipping fees in ECNY, Middle East energy traders cutting settlement costs drastically.
Okay, the advantages for China seem clear. But what about the downsides? That level of control must have trade-offs.
Huge trade-offs. The big one is privacy, or the lack thereof. For users, domestic or international, it means a profound loss of anonymity. The state potentially sees everything. That could definitely put off users or countries that value financial privacy, especially liberal democracies. It might limit its global appeal outside certain spheres.
And tech risks, cybersecurity.
Always a risk with any digital system, especially a centralized one. It's a big target. Plus, there's a broader concern. Could competing CBDC systems actually fragment global finance? Instead of making things smoother, we could end up with separate digital currency blocks, making international trade potentially more complex, not less. More friction.
Fascinating. So in this U.S.-China digital currency race, what about key Asian hubs like Hong Kong and Singapore? Where do they fit in? Let's start with Hong Kong.
Hong Kong's in a unique spot, trying to be that bridge to the mainland. They've got stablecoin rules, need local reserves, boots on the ground. But, and this is interesting, their capital requirements are really strict, like 3 times higher than Singapore's proposals. That might actually discourage the big global players like Circle or Tether from setting up direct shop there. Maybe that suits Beijing's preference for more control.
So maybe less direct issuance of global stablecoins, more using them through local partners.
Potentially, yeah. Focus on professional use, maybe, using offshore coins via local distributors. But ultimately, Hong Kong's success as this bridge really depends on what happens with capital controls and reforms inside mainland China itself.
Okay, and Singapore. They always seem quite pragmatic, adaptable.
Very much so. Singapore is positioning itself as a vibrant hub for private innovation, but also pragmatic about China's rise. They've accepted the RMB's growing role, even added it to their reserves. They adapt. And you see private innovation flourishing too, like Circle partnering with Grab, the big ride-hailing and delivery app there, to explore Web3 uses for stablecoins in everyday life. So Singapore's playing both sides a bit, engaging with state initiatives, but also fostering the private digital currency space.
So these two hubs, Hong Kong and Singapore, they're really crucial nodes in this whole unfolding picture.
Absolutely pivotal. Their regulations, their willingness to experiment, will hugely shape how digital money flows across Asia and globally. They're the test beds, the intermediaries, the places where these competing US and Chinese visions might clash, coexist, or find ways to connect. They are really critical points in this network.
Well, this has been a fascinating deep dive. It's crystal clear that digital currencies, CBDCs, stablecoins, this is way more than just new payment tech. It's a high-stakes geopolitical game, reshaping economic influence, financial control, sovereignty itself. We've got the U.S. leaning on private stablecoins, outsourcing innovation, trying to keep the dollar dominant, and even finding ways to fund U.S. debt through crypto users.
And then China, pushing hard with its state-controlled digital yuan, aiming for monetary independence, efficiency gains, and directly challenging that dollar system, integrating it into a vast digital Silk Road.
And Hong Kong and Singapore are right in the middle, navigating this complex new world, becoming these essential hubs for innovation and competition. It really sets the stage for a potentially very different global financial landscape ahead.